Hey there, awesome accounting student. Mark Franke here. This video is the Accounting 101, Chapter 4. Here we're going to look at adjusting journal entries in a merchandising environment and prepare an income statement for a company in a merchandising business. Merchandising business is a company that sells a product called merchandise, tangible personal property, bicycles, Barbie dolls, cowboy boots. And in this one, we're going to use problem 4-5B as an example. This is on page 184 of your text for the Foster Products Company. So we'll go ahead and set up the journal. And I've got some work papers in Canvas that you can use to follow along. And our first adjustment says, well, what they've done is they've given us a beginning trial balance, and I have put those beginning numbers into a trial balance worksheet that looks like this. 320,100 is the totals. So we're going to make these adjustments. Then we're going to post them into the adjustments column and then get an adjusted trial balance. So let's make these journal entries. The first one says, store supplies still available at fiscal year end amount to $3,700. In other words, still available means, we still have them. We went out and counted them. So this is month of October, 10/31, 2020. We'll call this one A. And we know we're going to debit store supplies expense and credit store supplies. We don't know the amount yet. This is to write off supplies used. And we've got the balance in supplies account. And that amount from the trial balance is $9,700. Supplies on hand, in other words, those are the supplies that we actually counted as $3,700. So the supplies used, which is the adjustment amount, is the $9,700 minus the $3,700 or $6,000. We debit store supplies expense and we credit store supplies. That's entry A. Entry B says expired insurance, an administrative expense, is $2,800. We didn't have to do a calculation. And by the way, anytime you do a calculation, write it in the journal. It's very, very important. In this case, we didn't need to make a calculation, so we'll just make the journal entry. They gave us the number, debit insurance expense. And the amount is $2,800, and we will credit prepaid insurance. Prepaid insurance is an asset. It's going down because we used some of the insurance, and so it's a credit. Assets always go down with a credit. To record expired insurance for October or something like that. All right, transaction C, which is at the top of the next page. It says depreciation expense on store equipment, a selling expense, is $3,000 for the fiscal year. So 10/31/2020, we're going to debit depreciation expense, store equipment for $3,000, and credit accumulated depreciation, store equipment, $3,000. This is to record depreciation for the month or something like that. Every journal entry needs a description. And then our last journal entry, it says that to estimate shrinkage, a physical count of merchandise inventory is taken. It shows 21,300 of inventory is still available at fiscal year end. So they went out and physically counted all of the merchandise inventory, and they found 21,300. Now, if we look at the trial balance, it has merchandise inventory of 24,000. So we had some stuff get damaged, disappear, stolen. We don't know exactly what happened to it. It's just gone. So we call that shrinkage. We are going to debit cost of goods sold. Even though these weren't sold, we don't know the amount yet. We're going to calculate it. And credit merchandise inventory. Merchandise inventory is an asset. It's going down because we had shrinkage. This is to record inventory shrinkage for October. Do you think this happens? It's for Walmart, it's millions and millions of dollars that inventory disappears. So the balance in merchandise inventory, is 24,000. That is from the trial balance. That's from the general ledger. The physical count was 21,300. So the amount of shrinkage, in other words, the inventory that disappeared, is $2,700. So there's our 4 entries. Now I'm going to go over to the worksheet and post it to our worksheet. And I'll just use the same letters. So my store supplies expense is A. That was $6,000. And store supplies, $6,000. Okay, so I'm going to stop the video. I'm going to post these and prepare adjusted trial balance numbers. So you could do the same thing. Post these adjustments, then get new balances in your trial balance and balance it out. This is really, really good practice. Okay, I'll be right back. Okay, I'm back and I've got my trial balance, my adjusted trial balance all balanced out based on the adjustments that we made. Notice that all of these adjustments, the debit is going to an expense account. That's very common. It doesn't mean that they all will, but it's generally what we're doing is we're writing off assets that have been impaired and have gone down and they end up in expense. So now we can prepare our income statement. I'm not going to do all the financial statements. They just asked us to do an income statement. And I've got a form that you can follow in the working papers. This is Foster Products Company. And this is an income statement, also known as a multiple step income statement. It's a merchandising company. And this is for the year ended October 31, 2020. And I can just link my accounts in Excel. I'm going to link it over to the worksheet. Sales is $227,100. That's a credit. I'm going to make this a little wider. And then we have some debits to sales discounts for $1,000. And we have a debit for sales returns. I'm bringing those over as negative numbers so that when we subtract the discounts and the returns from gross sales, we get net sales of $221,100. $221,100. Net sales is sales minus the discounts that customers took minus any returns that customers made. Then we have cost of goods sold. Cost of goods sold is $78,500. So gross profit, and this is a critical component. This is what makes this a multiple step income statement, is gross profit. $142,600. And we can calculate that. I'm going to go ahead and do that now. If I take the gross profit of $142,600 and net sales of $221,100, I can calculate the gross profit percent by dividing gross profit by net sales, and let's make that a percentage. So the gross profit percent for Foster Products Company is 64.5%. That's very high. Apple, I think, is around 35%. Grocery stores are typically around 10 to 15%. Grocery stores don't make a lot of gross profit. I think Costco is about 15%. I'll look that up and I'll put that in another video. But anyway, the point is 64.5% is a very high gross profit for a company that just sells products. Then we've got our selling expenses. We have depreciation expense. That is $3,000. Sales, salaries, $31,500. Rent on the store, $13,000. Store supplies expense, $6,000. And our advertising. These are all what we call selling expenses. Selling expenses, oops. What's going on here? There it is, sorry. Okay. Our selling expenses. These are all the expenses of running the store, basically. $71,300. Then we had some administrative expenses. Office salaries, $31,500. Rent, $13,000. Insurance, $2,800. When we add those up, we get total administrative expense, $47,300, which when we add it to expense, we call it operating expenses. And when we subtract the operating expenses from gross profit, we have net income of $24,000. So all the revenue minus all the expenses is $24,000. And we can calculate that net income is $24,000. Net sales is $221,100. And when we calculate that, it's called the net income percent. And again, we'll convert it to a percent. It's 10.9%. I'll highlight it and put a box around it. 10.9%. They've also asked us to calculate the current ratio. The current ratio is current assets divided by current liabilities. So our current assets is cash, $7,400, merchandise inventory, $21,300, store supplies, $3,700, and prepaid insurance, $3,800. Total that up, $36,200 is our total current assets. We only have one current liability, and that's accounts payable, which is $18,000. So our current ratio, which is current assets divided by current liabilities, we only have one, 2.01. 2.01. What does it mean? It means we have lots of assets available to pay our bills. A lot of it is in inventory, which is not a quick asset. In fact, the only quick asset that we have is cash. So when we do our quick ratio, which is the quick assets, in this case just cash, divided by our current liabilities, accounts payable, we have a quick ratio of 0.41. That's not a particularly good quick ratio, but it's because our cash is not very big and we have a lot of accounts payable. It is calculating the liquidity of the company. Liquidity means the ability to pay their bills quickly. And if all their bills are due in net 30, they're not going to have enough cash to pay their bills. So this is not a particularly good situation for Foster Products Company. Okay, there's problem 4.5B. That's it for this video. Practice, practice, practice. Be like Mike. I'll see you next time. Bye-bye.